Kathleen, because the IMF again downgrading the growth outlook.
Again, and in fact saying all the risks they were looking at back in April when they started downgrading, they have gotten even worse. At least that's how I interpret it. Risks overwhelmingly down to the downside as they warn of global recession. Now they're saying, what if there's a sudden complete cutoff of Europe's gas imports? What if inflation becomes more persistent? How about this escalation of China's property crisis? That's gotten worse, and renewed COVID flare-ups. They're all in line. So let's look at what the IMF's chief economist said about this today. He said that the outlook has darkened significantly since April. The world may soon be teetering on the edge of a global recession only 2 years after the last one. Now, in terms of what their forecast is for next year, we know the 3.3% GDP for this year, but it is now down to 2.9% for 2023. Very important to note. The IMF defines recession for the global economy as a GDP of 2.5%. Emerging market economies, developing economies often have much faster GDP growth than a developed nation. So that's how they get to that number. That's to underscore how close they think we are to a global recession if things get even worse. And with inflation up to 8.3% year over year, they expect this year up from a 7.6% emphasis. They say central banks have to get it right. That is one of the things that is going to make all of this bite the economy.
We see this kind of positioning, right, of market expectations. We're now seeing the expectation that the Fed will be forced to be less aggressive amid these rising recession risks. And we're still watching, of course, that indicator across a yield curve on what that says about the outlook.
Well, that yield curve indicator is something to watch. It has inverted, and that often can mean recession, and that is a big question. But, you know, if they do a 75 basis point rate hike, which is exactly expected, are you going to say that's a less aggressive Fed? Now, it's true. They're expected to perhaps front load rate now and then start cutting next year. That remains a question. Powell, however, is expected to say, yes, the risks are rising, but we still see a soft landing. We're not in a recession now. Labor market is still strong. He's seen putting the emphasis on the fight against inflation, how they have to get that right, and they are hoping that it won't have to go so long. If they do that front loading, they can kind of knock it under the chin. But I think one thing very interesting, I spoke to a former Fed official today about what they're going to do tomorrow. I spoke to a Wall Street economist. The former Fed official, both of them said the same thing. There's a slim risk of a 100 basis point hike tomorrow. Why? Because they do have to hit it hard. And what about the elections in November? In September, do they want to do aggressive rate hike? Slim chance, not anybody's baseline, but I just want to put that on the table because, wow, if they went back to a 100 basis point rate hike, that would be a huge surprise.